Afternoon, everyone. It's day 5 of our Investing for Income event, the last day. I know some of you have joined every day and some of you joining for the first time. We've saved one of the best for last. I always like an investment trust that's clearly named, and none could be more clearly named than UK Commercial Property REIT. And in fact, UK Commercial Property Trust, as it was, existed before REITs was a thing. It's one of the original diversified funds that allowed investors to invest into commercial property that the investment trust market created in the early 2000s. And it's been one of the largest constituents of that peer group ever since. Will's here today. He's going to give us a little bit of a guidance on where we might be in the property cycle. Obviously, it's been a really interesting time to be a property investor for the last year with interest rates and changes to valuations. And, you know, the kind of key question is, where are we now? So Will's going to talk a little bit about that. And he's also going to talk quite a lot about some of the really exciting growth areas that the trust is exposed to, and what that means for long-term investment. Just a tiny bit of housekeeping before I hand over. As I said, I think quite a few people on this call have been with us over the week, so you'll know the format. But for those that haven't, we'll speak for about 30 minutes. And during that time, you can submit questions in the Q&A box. I'll be able to see those questions, and I'll do my very best to go through questions you submit. Please submit those during the course of the presentation, and there'll be about 15 minutes afterwards where we can discuss that. So with that, Will, I'll hand over to you, and I'll reappear in about 30 minutes.
Alan, thanks very much. Hello, everyone. Thank you very much for joining in and listening to me today. As Alan said, I'm manager of UK Commercial Property REIT. It is quite a long name, so I'll shorten it to UKCM, or sub-market ticker. We're a member of the FTSE 250. Alan summed it up. It's an absolutely fascinating time to be a real estate investor and also as a shareholder and potential shareholder. Just to give you a flavour of UKCM, we own a portfolio of £1.3 billion worth of diversified properties, but as I'll show you in a minute, very heavily tilted at 60% towards the industrial and logistics sectors. At the moment, we're trading on a discount to our NAV of around 33%, which is, as you can imagine, something that is at the top of my and our board's attention. So we're at a considerable discount, very much in line with our peers, and we're providing a dividend of around 6.3% at the moment. The interesting thing is, and 2 points which fascinate me, particularly at the end of last year, the last quarter, we saw one of the sharpest falls in property values I've ever experienced since my career started in the late 80s, and as measured by MSCI, our index tracker, one of the sharpest falls in the property market. And that was delivered on the back of the expectation and the actuality of rising interest rates, rising gilt rates. So a big correction in Q4, and we saw the value of our portfolio fall significantly. But really interestingly now, we've issued our Q1 NAV, and our portfolio has risen. It's a mild number. It's gone up by 1%, but it's showing stability and a slight sense of optimism in that market. So from a valuation perspective, falling Q4, stability with a bit of an increase now, and operationally through that period, just to give you an idea, we delivered 19% earnings per share growth in 2022. So big focus here is improving and building the earnings. So that combination of a 6.3% dividend yield with our aim to build earnings, I think is quite interesting. The team, I won't dwell on this for long. The four-strong team, myself, Jamie, David and Michael, running the portfolio with finance support. And we're dedicated to UKCM here at Aberdeen, but we have wide support from debt specialists, structuring specialists, development specialists, everything that I could want to assist this strong team in running the portfolio. On outlook, as a house, we like to look at three phases of recent history and where we're going forward. And I'm going to try and bring that to life in UKCM and my experiences in my portfolio. Phase one, I think we're pretty much through. When gilts moved out to yield 4.5%, property yields were averaging about 4.3%. So there was a mismatch. You as a shareholder, as an investor, we weren't getting rewarded with a margin over a risk-free rate, and that led to this very, very sudden correction. So we've experienced that. In the portfolio where we are, we're at the start of an element of recovery. Rates remain high, interest rates 4.5% at the moment, but the operational portfolio and where it's invested is really strong, really good. So this operational base, tenants want to be in our buildings. We're at 98% occupied. Our rent collection is 99%. So we're set up in the right way, and I hope to demonstrate to build earnings. Interestingly, as a house, and we're more bullish, I would say, than many people out there, but we have a view that rates could fall to around 3% at the end of this year or early into next year. Now, we'll have to see whether that pans out in that way. But the direction of travel and what I see in the real estate market is that many investors are sensing and feeling that rate cutting cycle is going to come. Different people have different ideas of when, but we're suggesting it could be down at 3% late this year, early into next, and that has a real positive on real estate. So it's quite interesting that the fundamentals of a well-invested portfolio where tenants want to lease their buildings with earnings potential meets as well that potential for a rate cutting cycle later on. One slide on asset evolution, just to give you an idea of my thinking. I took this on to manage in 2014, and at that point, UKCM held around 45% retail, some shopping centres, some high street, and industrial was around 25%. So on those two areas, I embarked on a period of reducing the exposure the company has to retail. So we own no shopping centres, really no high street, and our retail exposure now at 13-14% is focused on a couple of supermarkets and the discount end of the retail park, which is really, really popular with tenants and people shopping. Equally, I put money into industrial, and that's now boosted up to 60%. So within those changes, there's a combination of selling assets, buying assets, but also value movements as well having impacts. So two things going on there. Offices, we own very few of 13%, probably the hardest and most difficult part of the real estate commercial market at the moment, with some particular difficulties around the corner, I think, for that element of the UK market. Combination of new ways of working, agile working. I'm in our office today, but I'm not surrounded by hundreds of people. So working habits are changing, and that's meeting a regulatory change where the government is requiring more stringent environmental credentials, EPCs, a little bit like buying a TV or a fridge. It's rated, each property is rated A to F. Each property has to be a rating of C by 2027. So some quite big changes there. And the final thing we did is adjust our investment policy, which was limited to leisure investment to allow us to invest in the whole wide sector of alternative commercial property, hotels, students, and so forth. I've talked about portfolio structure, so I won't dwell on this side, but it will be, I believe, available on our website to look at it in more detail. But it's interesting to look at our top 5 tenants. So we have a portfolio delivering quality income. I think you will recognize all these names: Ocado, the government, Amazon, Total, Armstrong Logistics. I wouldn't expect many of you to know. It's a brilliantly run business, and they operate out of a place called Magna Park in Leicestershire. Lutterworth, it's with the UK's dominant regional distribution base, and we lease a big warehouse, 380,000 square feet to Armstrong, and they in turn have a contract to help Aldi, the supermarket, with their distribution in the UK. So really good business in there. To bring it to life, I don't like going through these presentations without actually showing you some of the stock. So we are diversified, 60% weighted to industrial. And the top 2 pictures there are examples. Ventura Park Radlett is our largest single property. It's a multi-let industrial estate, around 14 units. This particular one is Unit B, and we got an increase of around 67% rent in January from the rent the previous tenant was paying. Collectively, in 2 deals at Radlett, we increased by 67%, one let to an aircraft maintenance company and the other to a film and media company. So Radlett doing great guns, and again, occupiers like it. Despite that big increase in rent, it still offers good value. It's on the M25, North M25. And then to the right, one of our investments at Leamington Spa. This one actually let to the government with around 3 years to go, and again, reversionary. So we're looking for the next lease opportunity to put the rent up, and that's around 270,000 square feet there. The blobs or the dark patches on the roof are actually solar panels. So throughout what we do, our ESG credentials are really important, and this is an area where we can both make it more efficient, more environmentally friendly, but also help our tenants with cheaper electricity. Going round clockwise, hotel in Newcastle, a long lease, around 30 years, to a company called Delata. They performed very, very well through COVID, kept paying all our rent. This lease is index linked, and it's very close to Old Square, right in the centre of Newcastle. Does really, really well. Phenomenal manageress running that hotel. If anyone is visiting Newcastle, highly recommend it. And then in the middle bottom, Junction 27, a really, really dominant retail park on Junction 27 of the M60, with a huge sort of multi-conurbation and population demand around it. An IKEA store out of the picture to the right-hand side. So people comparison shop into IKEA, eat their meatballs or whatever, walk down to our retail park, and they can have a lot of furniture comparison shopping in here with good value rents, very, very profitable for retailers. And then finally, offices, hardest bit of the sector at the moment. This is one of our office buildings in Reading, White Building. It's a fully electric building. By that I mean that the air conditioning and heating systems are electrically powered, which is one of the key components of being environmentally acceptable for the government legislation coming through. So the EPC works here, young workforce in Reading, many offices around the country, most in fact are gas powered, which leads to the requirement for quite significant capex to adjust over the next few years. So this one doesn't, which is good. Development activity. So we are adding £6.9 million of income into the portfolio from our December numbers over the next really year and a half. Most of our development pipeline is completed. The notes give you more information on the left-hand side. But I'd show you 2 here. One is Bolney, between Brighton and Gatwick. Really nice little industrial estates, 2/3 let to a geological consultancy company, 1/3 really good interest in, and we're finding that the rental value of that is around 12% ahead of our appraisal rents when we entered this development. And then our largest current development, which completes in summer next year, this is an artist's impression of a hotel in Leeds. We're going to operate this, which is akin to our student development scheme in Exeter, and the Hyatt. We're going to come in here. We'll operate this and expect to get a 7.25% yield on this investment when it completes, around 300 beds. I could go on for long, but if any of you on your way down from Newcastle are staying in Leeds, you probably noticed that it's very difficult to get a good value hotel that isn't really poor quality. So we'll be offering this at room rates below £100, right beside Leeds railway station, really hoping Leeds Football Club stay in the Premiership as well. But actually, regardless of that, great university city, good demand, and we think with a rooftop experience going in here, mix of hotel rooms, good value, that will do tremendously well, backed up by our analysis. This slide, called Rent Bridge, based on our December 22 results, looking forward, is probably the most important slide in this pack. It shows the potential for UKCM, our company, to have its rents grow by around 30%. Now, that's over a period of time. The way the slide works, on the left-hand side, our current rent in December 22. The next tranche of blue bars represents £6.9 million of expected income coming through from the development completions I mentioned. Most of those have completed or about to complete. The bigger bar is summer next year from the Hyatt Hotel. Going from the middle light blue bar to the right-hand bar, we have another around £16.9 million of income coming on stream. And that is the ability to convert rental value in the portfolio into cash rent. So many of our properties are let at a rent, a little bit like the example in Redlip, where we got a 67% increase. They're let below their real market value. And this is looking at the increased potential in that. We don't, however, give you in that slide any idea of time. Is it a week away? Is it 10 years away? And in fact, the biggest bar there is the £12.9 million of true reversion conversion potential, converting rental value into cash rent, great for earnings. And the middle table there shows that the bulk of this is coming from our industrial estates. In fact, that table represents probably around 60% of the reversion conversion we've got. The table below is looking at years, how quickly we can receive it, and around 30% of that is available in the next 2 years, 23 and 24. We've already delivered about half of 23. So the point of this is converting rental value into cash rent is great for company income, great for earnings, and great for the potential for where dividends could go. Detailed slide here. It's a number of asset management activity that we've been busy with just in Q1 of this year. And it's summed up, I think, by the boxes at the very bottom. So on the left-hand side, lettings at Ventura Park Radlett combining to a 69% increase in rent. Great, if you like, proof of the pudding. Fine having slides up showing this reversion. This is actually proving it, deals we've done. And then on the right-hand side, a variety of deals, another industrial at Bristol, an industrial in London, where we have a lot of our industrial money, 4 industrial estates. This is Dolphin Estate, Sunbury-on-Thames near Heathrow. And finally at Trafford Park in Manchester, where we got a 16%, 17% increase from Kentucky Fried Chicken. Trafford is fascinating. If you've driven up the M60, you pass Trafford Centre on the right, or Trafford Retail Park on the left, and it operates actually as an informal service station. Everyone coming off the motorway, we have 4 food outlets that do fantastically well, and then behind that, a traditional retail park with people like Dunelm, Home Bargains, TK Maxx in the air, which operate as a mini retail park for the local suburb of Manchester. So it does really well. 40% increase in rent there. Debt. moving quite well through this presentation. I'm sure you'll be pleased to hear, but on debt, this is a vital part of what we do. And I feel at the moment there isn't enough examination in the sector of the exposure different companies have to sectors of the market, or indeed their debt situation. So we have 20% loan to value on our debt at the end of March. Our weighted cost of debt is a low 3.93%. And interestingly, almost 70% of that is on a fixed rate, 2.9% basis. So it's fixed for good duration at 2.9%, which I think is really important. The rest of our debt is on a floating debt basis, and we can pay back and draw as we want. And one of the things that we're looking at the moment is whether we might look at perhaps selling an asset to pay down a little bit of that revolving debt. So low debt, very sensibly managed. Almost at the end on ESG, but actually really important for everyone, for me as a real estate investor, for any of you as shareholders. This matters because tenants are becoming far more sensitive to the properties they're taking, that they're environmentally sound, they're socially, particularly in the office sector, they offer amenity for tenants, and governance, which is, as a REIT, is very strong there. So we focus, we're keeping this very simple at the moment and focusing on, first of all, the regulation from the government, this EPC that I mentioned, and the pie chart on the top right shows that 82% of our buildings are compliant with this 2027 EPCC requirement, which is great progress, and we have a plan for the others. The second part is our carbon neutral goals. The charts there look identical, but we have two goals. One is that we are going to be carbon neutral by 2030 for carbon emissions, carbon output. We as a landlord control. That's measured in the top chart. The bottom chart is looking at our position towards our goal of being 2040 carbon neutral for the whole portfolio. And if you were to zoom in on the vertical scale, you can see that the carbon units of output are far greater, far bigger. So most of the carbon produced by our portfolio, which is common for all landlords or companies, is tenant emissions. And so we'll be working with our tenants who have the same carbon neutral goals at different time periods in their own industry. So those two things are really important for us. I thought it'd be interesting to put in what I believe is an aptly named chart, share price dislocation, and really everyone will come to their own views on that. But it's really quite interesting for me looking at our NAV in blue against our share price in orange at this. Two things really: the reduction in the NAV following the experience at the end of last year. We had a slightly probably larger drop than some of our peers because we have a collection of such good industrial property in and around London, which is delivering really good earnings growth. So that NAV has come down. Q1, we're up 2.2% NAV total return, but our share price is languishing at 33% discount. So I think that linked to the 6.3 dividend yield, really interesting, and the potential for earnings growth. Finishing up, diversified portfolio, I've mentioned that, very strongly weighted towards the industrial sector, and a lot of that money in London. Prudent debt, high occupancy, tenants like the portfolio, and a strategic focus on earnings growth. Alan, thank you. I ran over a little bit there, but I hope that's all right.
Oh, you've actually come in slightly ahead of time, which is perfect. So, as I said at the beginning, a company with a very, very explicit descriptive name and a very succinct presentation to accompany it. Thanks, Will. I'm gonna ask you. I'm gonna put you a bit on the spot here, and I suppose the story of UKCM, and property trends take a long time, don't they? So equity. If you're an equity investor, you get excited about themes that play out over 18 months or even 5 years, but property can take a lot longer, can't it? And if you think about UKCM, there's a sort of story arc of how property assets have changed their use over UKCM's life and your tenure. You've repositioned it into these assets, which in some cases, before your time, industrial assets were all on 10% yields and oversupply, etc. And the world's changed. And so one of the recurring things we hear from property fund managers is about the office sector, and you're no different, that it's a very difficult place at the moment, and it's very easy to stack up a list of problems with the office sector, which are real. It's a really big social change, isn't it? But what do you think the way out is? What do you see over the next 10 years for UKCM? What could make you start to reposition into that sector?
Right. And so first point to note, Alan, thank you. Yeah, no, it's not putting me on the spot at all. I think it's fascinating, and I'm very clear about it. We own 4 offices, 13% of our portfolio. One of those, and this might be an odd thing for me to say, is one of the ugliest offices I've seen, but it sits, and it's on a lease for 9 years, giving a very nice yield. But it sits right beside Park Royal in London, which is Europe's dominant logistics distribution hub. So we bought that with a view to getting a really nice yield and then being able to redevelop or sell to someone to redevelop as potentially industrial. So that's one of our offices. And I'll come to actually your question where I think the market is going. The second one that's interesting is an office that is leased to the government for around a little bit less than 3 years, right beside Temple Mead Station in Bristol. And if anyone knows what is happening in Bristol, they're realigning. Beautiful station as you come up the ramp, but they're realigning the entrance to that so that you will then come out of the station and immediately face our building, on top of which we can put 2 extra floors without doing anything to the structure. So we're looking at the prospects of, one potential is that we're in the process of getting planning permission for a fantastic office. It's probably one of the best sites for office development in the whole of regional UK, and one option would be to get planning and then look to sell that. The other 2 I talked about, the White Building in Reading, and we have a very small one in Newcastle we're working on. But getting to your question, it's really, really difficult at the moment, which is why, on purpose, we own very few offices and none of these really stranded offices that we're worried about. There's one very small one in Newcastle, which we need to do some work with. And I think over the next few years, people don't seem to have, they're aware of it, most landlords are aware, but no one is actually ready to jump in and spend the money. Probably 85-90% of offices throughout the UK are in a difficult regulatory position with this EPC nature. So we think there'll be a lot of investment needed for which tenants aren't going to reward landlords with rental growth. And that's just that side. The other side, as you mentioned, the agile workforce. Everyone on this call will have a different view as to what is the best or right way or how to work in an office. But I think everyone will agree people aren't and are really unlikely to be working 5 days a week in an office on average, and that is cutting demand. And I think that people will focus, businesses will want to reducing their rental budgets, and they'll focus that on a smaller number of best in class offices. But those themselves are still have issues. So I'm steering clear of the office market at the moment. There will come a point, I think values will come down in that office sector, and there will come a point particularly for best in class, because we still need offices. That would be interesting for investment, but it's not on my radar just at the moment.
A little bit more of a kind of practical question. Do you want I mean, property valuations, it's a very well established process, but I guess not every investor is aware of quite how well established, there's a, the Red Book value. Do you want to just do a kind of Red Book 101, if I can
Yeah.
use a phrase that almost no one on this call will understand, but you know what I mean. Just walk people through how assets are valued, because the question that people always ask is, are there external inputs? Is this just you putting a finger in the air, or how is there someone external, independent to you, who's providing an input? I think that's fundamentally what people want to know.
Yeah. Three. I can simplify it. There are three things to say. First is to confirm that UKCM, this company, as with different people, REITs will be, we're valued by an external company, in our case CBRE, and they perform an external valuation every 3 months, every quarter. They'll revalue the portfolio, and that is the building block for our NAV. And each year, our auditors will also have a good look at that valuation. In terms of the principle of the Red Book, so they are RICS, the Royal Institute of Chartered Surveyors. They're accredited valuers, so they have they need to follow a procedure and a set of rules laid down as guidance by the RICS on how to value. At its simplest level, if imagine you lived on a street of identical houses, and you sold your house for, let's say, £500,000, then if the house next door, I'm probably teaching people to suck eggs, but if the house next door is identical, there's a fair chance that would get £500,000. And so in offices, shopping centres, industrial and residential, nothing is ever the same. So the valuer will make an adjustment to evidence in the market, deals that have been done, people buying and selling. They'll adjust that based on their experience, the length of the leases, the strength of the tenants, the demand in the investment market for that sector, and they will come up with a value for property. In exceptional circumstances, where there isn't enough evidence to come up with a value, they will put a health warning on their valuation. But they haven't done that for a long time, even through the period of significant rate rise. It's very rare for that to happen. So the valuers have enough evidence, and that was part of this Q4, Q2, Q3, Q4 fall. Rates rising, investor appetite was re-rating against the expectation of returns. They had enough evidence to do that. And the third thing that's interesting is there is, lights are changing here, there is a movement in the industry to, instead of saying the building next door sold for this, therefore this is what you'll get, the sophistication being brought to bear on these valuations is a lot greater. There's a push to look at cash flow valuations far more, which is how investors would look at looking at the internal rate of return an investor would get. So when I'm out buying a building, I will prepare a cash flow. Bricks and mortar are great, they bring things to life, but it's all about cash flow. What will this earn the company if we buy it? What will happen to value? And valuers are being encouraged to shift to more of a sort of cash flow based process. So really interesting. And again, just I think that portfolio that we have in I suppose the sheds, beds and discounted retail space is particularly interesting.
Yeah. There's a question about dividend, your dividend cover, and the dividend slightly uncovered, and the question centers around what are the risks to the dividends, and the probability of those risks. And I guess the flip side of that is, as you've already alluded to, there's quite a bit of reversionary potential in the portfolio. So what are the risks of the dividend becoming covered in the short term?
Yeah. I don't know if people can still see the slide deck that's on screen.
Yes.
Yeah. if you can. So I've just put up as a reminder our rent bridge from 2023. So we were I'm going to say, I stand to be corrected, 98% covered for 2022, and our Q1 figure is 95%. So you're right to draw out that there's a small element of uncovered there, but of course the beauty of trusts and REITs is that we can manage that within the company. The rent bridge for me, and this, dividend is about earnings. So we aren't 100% covered, but we're not very far off. And we have an expectation, admittedly over time, but as I think I demonstrated on the second slide here, a lot of that relatively short term, to grow our income stream through the popularity of our buildings and the fact that there's been this cyclical shift in rental value, particularly industrial and logistics around London. A threat to that, I should also say the quality of our tenant base is good. That good top 5 tenant base, a whole load of 190 diversified tenants. Beside that, not everyone is bulletproof by any means. We have a small exposure to Cineworld in there, with whom we're having quite a lot of conversations at the moment on what is a really, really strong cinema in Glasgow, but nevertheless, one could say there's a risk to income there. But by and large, across the portfolio, great tenant base with a projected growth to income stream. So expected to grow. Interest rates at 4.5% make our revolving debt more expensive. So we're very tuned in to on the small element, the 32% of debt of our 20% overall gearing that's exposed to rising rates. So we're looking at that very carefully at the moment. And I suppose were rates to rise further, which is not what we're expecting. In fact, we expect them, as I said, to come down, then that will have a negative impact on earnings. So threats are tenants not paying the rent, going bust. We've got a good quality portfolio. Tenants want to be there. We won't be immune. We haven't been immune, but we're in the right side of that. So I'm very confident there. And interest rates, we're all over.
Right, and just on another potential risk, we saw that I think it wasn't quite as severe this time around as it was in the financial crisis. But open-ended property funds closed their doors and were forced to sell some assets last year, weren't they? It was somewhat moderate, I think, but it still remains the case that some of them are unable to meet redemptions and are looking to sell properties. Do you see that as an opportunity? Do you think there's a significant kind of pipeline of sales that could still come through? Because obviously, with you could see a scenario, couldn't you, where valuations have fallen now, so it's kind of in the numbers. So now's time. Could there be another wave of selling, or do you see what I mean? Is there another risk from oversupply?
Two questions there. Investors in the marketplace, with the changes in values that happened at the end of last year, thought, and there's a lot of money that would like to invest in UK real estate, they thought they would have the pick of the bunch. It would be very easy to go out and buy very difficult offices. So, but the expectations of buyers and sellers, I'm not sure really are matching in that space at the moment. But to buy strong performing assets, many investors have found it very difficult, and that's actually leading to that edge up in pricing that we've seen in our property value. Interest rates will impact that as well going forward. Luke, you'd expect me to say this, but I really believe it. I think the closed-ended environment, the REIT, is a brilliant way to hold property exposure. I'm not forced to sell assets because of redemptions that are being queued up because people want. I can model a portfolio, and I can know that for shareholders, I'm working on delivering performance from that without having to perhaps sell my best assets at the times of the market when people want money back. Equally, shareholders, investors, we're, as you said, we're we are one of the biggest diversified REITs, and we have good liquidity. So there is that ability for shareholders, even in poor markets, to, if they need to, get their money out, which I think is really important as well. So the sort of gating or closing that much, not all, but much of the open-ended market has experienced, we don't. And I think that's a great position to be in. Difficult to predict where that open market, open-ended fund market will be. A lot of talk about it. I certainly have had more meetings than we've had, and that's a combination of people looking at where values have gone to and the potential, I suppose, but also more meetings with people looking at open-ended v closed-ended as well. So it is quite an interesting time. Yeah.
And you mentioned, possibly easy to buy difficult assets, not so easy to buy good assets. Do you think that's what's behind? I mean, it's not a wave of corporate activity, but there is some corporate activity, isn't there, in the REIT space, and the big one being the industrial REIT. And I was about to say you don't need to comment on that specifically if you don't feel comfortable, but actually they published their NAV before the bid's gone through, didn't they? Which kind of proves that the bidder was right. So they've done that.
Yeah, look, industrials, as I've said, I really like them. We as a house like them. We think there's a long-term thematic playing out with e-tailing continuing, so buying goods online and also onshoring. So people want to be closer, so that there isn't enough stock in the UK, and that process with industrial REIT sort of gives a bit of verification to, the perhaps there's more in this than the share price alludes to. So yeah, we're as I say, we've got a lot of interest. It seems to me from meetings looking at, is this an interesting time to invest or not? But that's up to anyone on the call to make their own mind up. But I think it does. I suppose for me, it gives me confidence that what I'm saying is not my view alone. That there are other people out there who think there's more value in these things.
We've got a couple more minutes, and there are tons of questions about inflation and interest rates. And I think in fairness, you've kind of given your views on those. So just one last thing, could you just talk us through obviously the trust is on a big discount, and one of the options is to buy shares back, and there are pros and cons of that. Do you just want to talk us through your thinking on?
Yeah, so it'd be right to say that it's a very regular discussion that the board have and that we have in conjunction with the board. In fact, Alan, we made the decision last year, instead of executing a share buyback program, and different people will have different views on this, but we made a £25 million special dividend payment over and above normal quarterly dividends. And one of the things that we could have done with that was buybacks, but with the board we wanted to treat all shareholders, if you like, equally, not just those that might participate. So whilst we haven't done a buyback, we did make this special dividend payment, but we continue to look at the possibility of buybacks and effectiveness against impact on debt. Gearing up for buybacks might not be the most thing to do. Ability to pay down debt, improve earnings that way, or again about stock in the market, and that depends pricing. So those three things are frequent. I probably can't say any more than that, if that's all right.
I think I understand that there are subtleties to this, but I think we all know from the last financial crisis that if you've got cash on your balance sheet when there's credit tightening, it can be a pretty sensible thing to hang on to it until you can see a way out of it. It's not quite as severe this time, is it? But there are echoes, and
I think we are in a different position. I think that we're finding banks will lend to good quality assets. In fact, we extended the financing on one of our facilities quite recently. But again, it's the quality of the portfolio, whatever that are there. So yeah.
Good. Well, that was really fascinating. Thanks for sharing your thoughts on the future as well as the present. Really interesting. Everybody, there's a lot of information, obviously, on UKCM's website. Report and accounts get written with a great deal of attention and effort and contain a wealth of information, and it's always good to do some primary research of your own, as well as relying on the excellent Kepler website, which also has plenty of information. If there are any other questions, you obviously know how to contact us, and so please do get in touch. Thanks to everybody, and I can see there's quite a number of people who've been here all week, so thanks, and all feedback gratefully received, so we can make the next event just as good or even better. And we'll really appreciate your time, and we'll see you again soon.
Thanks, Alan, for listening. Bye bye.